account. I mean 2018 account. 2018 account, the year of assessment will be 2019. Now we're in 2021 year of assessment. The accounting year will be 2020. So that's how tax works. So basically, in this company, they have what they call building, you have motor vehicle, you have tools and equipment, and you have the total. Now, for this building, the figure you have here, the figure we are having here, this figure is called the tax written down value. That's how they call this figure. The tax written down value. That means that it's just what is left after you've deducted some capital allowances. In accounting, we call it carrying value. Carrying value, that's the amount left after you deducted depreciation from cost. That's what they call carrying value. But in tax, it is called tax written down value. Okay, so this is the tax written down value. Now you claim this 15 here means that you are going to claim 15% initial allowance and you are claiming 10% annual allowance. Again, this 50 here means for motor vehicle, I'm claiming 50% initial allowance. I'm claiming 25% annual. If you do not claim it, nobody will give you. In tax, you must claim anything you need. Government, even though they give it, the law might be nice, they'll be looking at you until you claim it. And when you're claiming it, you defend it properly so that they won't cancel your claim tomorrow. Okay, so tools and equipment 50-25, 50% initial allowance, 25% annual allowance. Okay, so and the total is given here. So this the tax written down value, and the figure here is the annual allowance. The annual allowance, and when you deduct this figure from this figure, that's you are deducting this figure from this figure, you are getting the new tax written down value. So I can say TW, that's tax written down value. You can put it there. So this one you can call this AA. Okay, you can call this IA, initial allowance. Now there's no initial allowance here. Why? Because the initial allowance have been claimed before in the past. Like this is written in full, initial allowance. In some analysis, you see that IA, initial allowance AA, and IA, annual allowance AA. So this initial allowance, this 15% have been claimed from the beginning. So they cannot claim it again. They can't claim it again. Okay, because have been claimed from the beginning. Okay, so it's claimed once, after which then you don't claim it anymore. So you just be claiming your annual allowances. Okay, so it's very key that we understand the concept of initial allowance and annual allowance. And at the end of the day, what you will claim or what you want to take, what you want to claim from the tax office is this total. This total here, that's what you want to claim. That means that this total ordinarily is the addition of the annual allowance for building, annual allowance for motor vehicle, annual allowance for tools and equipment. It will give you this total, and that's what you want to claim. But if you have initial allowance here, what you will claiming is the addition of the initial allowance and annual allowance. In some instances, you have investment allowance, you have initial allowance, you have annual allowance. You can claim other, especially for manufacturing companies. You can claim a lot. Okay, so but in this scenario, we are claiming this 527,500. So that's what we are claiming. So then we'll move to the tax computation. The tax computation, the tax computation basically is a schedule you need to have kept. Okay, you need to have kept your tax computation schedule, and your tax computation is from 2016. You know what you paid as your tax, CIT, education tax. 2017, you know what you pay as CIT, education tax. 2018, you know what you paid as CIT, education tax. But our interest here is 2019 year of assessment. And why you need to keep this file is so that you can always look at your tax history. And oh yes, I've been paying my tax. Look at my computations, look at my payments. Why are you disturbing my company? Okay, so they look at it with you. Oh, sorry for disturbing you. You are a law-abiding company. They will go and meet someone else. So basically, the year of assessment is 2019 because my accounting year is 2018. And I told you that CIT is based on preceding year basis. That means that the account for 2020 now, the year of assessment will be 2021. However, PIT, that's personal income tax, is based on actual year basis. Okay, that means that for 2020, you see 2020 in filing your return. So in 2019, which I'm looking at 2018 account, I've showed you 2018 account. Its basis period is 1st of January 2018 to 31st of December 2019. So this is a full year, normal year. Some companies have the accounting year end in March. Some companies have accounting year end in June. Some people have their accounting year end in September, but this is a normal accounting year end. So that's why you don't need to tell them this is your basis period. Okay? So your profit before tax, you pick it from there. Now here there's a loss before tax, there's a loss before tax, and now there's a loss before tax. You can put profit or loss before tax. So if you look at the loss before tax, you go to the income statement, look at the loss before tax. The loss here is 920,113. It's in brackets. So even though they call profit, it's a loss. This is in bracket 920,113. That's the loss there. So that's what will come to your tax computation first. 920,113. You will now less non-taxable income. You less this. Like you see some of their revenue, they have investment income, dividend. Okay, net in the notes to the account. Look at the notes to the account. You notice that in notes, one of the notes for revenue, they have net investment income dividend at 7941, meaning that withholding tax have been deducted from this, so they can't pay tax on it again. So you less your non-taxable income, any other non-taxable income you have, you less it. Okay, so you have that. So when you have this, it therefore means that you are going to add back what we call uh, non-deductible item, some expenses that are not tax deductible, like depreciation. Depreciation is 508. You pick that, add it back to it. Pre-operational expenses, 95,000, add it back to it. Fines and penalty, 24,000, add it back to it. Donations to local cultural group, 1.2 million, add it back to it. The taxman will not accept all this. You can find all this in the notes to the account under notes, note to the account, especially note 4, especially note 4. So okay, so ordinarily the the depreciation here figure will be added back. You pick the depreciation here in note 3. The depreciation figure here is not acceptable from the taxman. You copy it, you paste it under depreciation because it's not an acceptable deduction. You add back depreciation. You see now, I've added back the depreciation because the taxman will not accept you to deduct the depreciation. They will add it back. Then you now see, you go to note 3, you see what we call professional expenses. The taxman will not accept professional expenses uh, because here is written off systematically. So most times, although it's an issue in the tax law, but most times it's not acceptable. It's not accepted. So you add it back to your tax completion. You see, my professional expenses, I've added 95,000 back to it. Fines. Again, there are some fines that they paid that is avoidable, and they take it as a deduction in their books. 24,000. Taxman will reject, will go against that. Add it back. Donation to local cultural group. Donation to local cultural group. You know, there are some donation that the government will approve. If you donate for COVID-19 approved fund or Boy Scout, Girls Guide, Boys Brigade. There are some approved organizations that you can donate to that will be allowed. But this one is a local, it's a just a cultural group, no name. Okay, actually, it's called to local cultural group. Okay, so it's a local cultural group. So this donation is not accepted by the taxman. So that's why you copy it, this figure, you just copy this figure and say copy under your tax computation, you paste it back. You paste it because it's not acceptable. So all what this will do is that your taxable profit will go up. The taxman want to tax you the more. They don't believe that you made a loss. They don't believe. They believe that you are the one, this loss is not real from a tax perspective. So they are looking at it, adjusting your book so that profit will come out. But if you are a very good accountant, you can always defend your loss. So basically, we have that. Then after you've deducted it, you can see this figure you have here. This figure is called accessible profit. Accessible profit. Some people call it adjusted profit. But for companies income tax, I'm not talking about petroleum profit, but company this is accessible profit.